Greetings, folks. This is DC Investing. I've reached financial independence, and I'm talking about topics that may help others on their path to financial independence. And today, the topic I wanted to talk about is the hidden Roth account. It's not technically hidden, but it's least understood, and understanding it can provide great returns for you if you understand how this works. So it's mainly the that saving funds into an IRA or a 401k pre-tax have a secondary benefit that acts just like a Roth account, as long as you don't take it to extremes. So if you're not as familiar with how IRAs or 401k plans work, basically when you make a contribution to one of these accounts, your contributions go in pre-tax. What that means is you do not pay tax on the funds that you deposit into these. And what this does is it ends up giving you an immediate tax increase, or investment increase, an increase on what you saved. And that amount depends on what your tax bracket is. So if you're a young person, I guess if you're young and married, you can earn up to $30,000 and pay zero tax on anything that you earn. And so if you're earning less than that, then don't put money in pre-tax accounts. If you have anything left over, put money into a Roth account, because once money goes into a Roth, it's never taxed again. And if you're making less than $30,000, you're not taxed in the first place. And you might say, well, no one can live on $30,000 a year. Why would that even apply? Well, some young folks don't have huge expenses. They may be living with parents. They may be working some. They may be going to school for part of that time frame. And so you may end up in a case where you're earning less than $30,000. And if you can, saving money into a Roth account means any of that funding that gets in there, you've paid zero tax going in, and you'll pay zero tax forever because it's a Roth account. So kind of the hidden Roth acting account is if you're over that amount, then you start to pay tax. So there's the 10% bracket next. So any amount over 30,000, I can't remember. It's like up the next $15,000 if you're married. You pay 10% tax, and then on top of that is the 12% tax that goes up to, it's about 120,000-ish, assuming you're married. Uh, that's in the 12% tax bracket. It's different if you're single, but basically it's, there's an amount where you cross over into a higher tax bracket. So if you're in the 10% or 12% tax bracket, this still works for you. And so what happens is, if you have an employer plan, a 401k, any money that you put into that plan, you save either 10% or 12%, or if you're in a higher tax bracket, 22 or 27, I guess next is 24, 27, all the way up to 37%. So you save that money, and what it turns into is an immediate investment gain. So any money that goes into this account doesn't get taxed at those tax bracket rates, and so you get that as an investment gain. And so that's a way to increase your investment returns, and is a good thing. Now, the hidden Roth acting benefit, and that works for either an IRA or a 401k, is that when you take money out of your 401k, as long as it's small enough, you'll also pay 0% tax on it. So it went in at 0%, can grow for a while, and when it comes out, you'll also pay 0% if the amount that you pull out per year is less than the standard deduction. So that's really kind of important to understand. And for a married couple, the first $30,000 that you pull in retirement from a retirement account, you will pay zero tax on. So essentially, the funds went into either your 401k or your IRA. You paid 0% of tax on that. So because you would have been taxed anyways, you made either a 10% gain or a 12% gain or a 22% gain, or all the way up the deduction or the tax bracket thing. And then when you pull the money out, as long as you're pulling less than $30,000 a year as a married couple, you will again pay zero tax on it. So you get to harvest that gain and keep it for the rest of your life, basically. And so if you can project to say, I'm going to try to retire at, say, age 50. So I'm going to pull money out every year until I'm 60, 70, 80, or maybe you retire at age 60 and you have 70, 80, 90. As long as you're pulling out $30,000 or less every year, then you've essentially paid 0% tax on those funds. So every gain that you have, um, you got the amount of the tax just built into it. So that's how it kind of acts as a Roth account. Now, you might say that's not really realistic to just pull $30,000 out. Well, the thing that you pair that amount with is, if you have a Roth account, any amounts that you pull out of a Roth account are tax-free. And also, if you have a brokerage account, if you save money into a non-retirement account, you can use those funds during retirement for tax benefits. And there's a benefit to having investment funds outside of retirement accounts, because long-term capital gains and qualified dividends are also taxed at 0% up to about that $120,000 range when you include the standard deduction. So, I always kind of remember the crossover where long-term capital gains and qualified dividends start to become taxed is about the area where the 22% tax bracket starts. So that's just kind of a general rule of thumb. If you can keep your income below that amount, then you get really great tax advantages by being able to live off somewhat lower of an income. So, let's say for 30 years, every year you're going to pull out the equivalent of $30,000 from your retirement account. That first $30,000 you're going to pay 0% tax on. Then let's say you have some long-term capital gains that you're going to sell. And when you sell a stock, you get the capital that you invested back out that's not taxed. It's just the increase that you get taxed on. So let's say you had a $100,000 investment, it went up by $25,000, and you sold the whole thing for $125,000. Well, you're only paying tax on that $25,000. So you take from your retirement account, you take that $30,000, you add $25,000 to it. That's only $55,000. You're still paying 0% tax on all of that funds. And in theory, you can take it all the way up till about $120,000 when you're married, with long-term capital gains and qualified dividends and a $30,000 a year withdrawal from a retirement account, and still pay zero tax. So that's how a normal pre-tax account can act as a Roth account, because anything that was in the account is taxed at zero when you take it out, as long as the total amount you take out is less than $30,000. So the way I think of that is, there's kind of a sweet spot for the amount that's good to save into a pre-tax IRA. And kind of the number that I'm sort of thinking about is about a $600,000 amount. It might go up just a little bit. And over the years, whatever you have in that IRA will grow. And the idea is that you should be able to pull funding out of that IRA at 4% and have it never be exhausted over a 30-year time frame. And so if in retirement your plan was to, say, pull it out at a 5% rate, you have $600,000, well, that turns into $30,000 a year. And so if your plan is to kind of slowly exhaust your either IRA or 401k, you may have to play with the numbers a little bit, but as long as over that 30-year time frame you can completely exhaust your 401k over that 30-year time frame by just pulling $30,000 a year out, well, then you paid 0% tax on all of that money that you put into the IRA. So you balance that out with any of your investment returns from your brokerage account, whether it's qualified dividends or long-term capital gains. Your Social Security will play into that somewhere over the time. And if your income's low enough, Social Security isn't completely taxed. It may be taxed at 50% or 80%. It's still a beneficial amount. But by playing games with these retirement accounts, you are in effect figuring out a way to make a higher return by using these tax strategies in retirement accounts. So putting money into an IRA or a 401k, you pay 0% tax, so it turns into that same amount of a gain on your investment. So you can count it as a 10% gain or a 12% gain or 22% gain, whatever tax bracket you're in, you're harvesting that as a investment gain, which is a great thing. And as long as you don't have too much in your retirement account, when you pull it out, it'll turn into a 0% payment or 0% tax hit when you pull it out as well. So it's really powerful that way. Now, where people get in trouble is if they have too much saved into their 401k. So I would think that if you have over $1 million or more into your either IRA or 401k, that's where you start to run into tax issues, because when you pull money out of the account at those higher rates or higher amounts, it starts to work against you and you get taxed on those amounts. So any amount over $30,000 you pull per year out of a retirement account, well, then you're in the 10% bracket or the 12% bracket or the 22% bracket. So money coming out of a retirement account counts as ordinary income. Whereas if you had that same fund in just a brokerage account, you would only pay taxes on any long-term capital gains or qualified dividend amounts if they get over a certain threshold. So having too much in a retirement account can actually work against you towards the end of your life. And there's also something called a RMD, which is a required minimum distribution. It happens when you're over 70. I don't know if your age is 73 now or 75, but basically if you still have funds in a retirement account, the government forces you to take money out, and that can result in, if you have a huge balance in your retirement accounts, that's where it can cause some problems for tax purposes. So so that's kind of, because you may have $200,000 you're forced to take out every year, and that puts you in a higher tax bracket. So may we all be blessed with having high balances in our accounts. You could have worse problems, but we want to try to optimize what we do in life so that we pay the least amount of tax and have the best gains. And so having a balance in your retirement account of somewhere between $500,000 to $1 million gives you a lot of flexibility with how much you're going to take out of a retirement account every year. I also recommend having funds in a brokerage account so you get the benefit of qualified dividends and long-term capital gains. And it's also great to have funds in a Roth account as well, because that never counts as income. So you can kind of strategically figure out how much to pull out of a retirement pre-tax account, how much to pull out of a Roth, how much to sell in terms of long-term capital gains, figure out what your qualified dividends are. And all of those added together, you can play strategically how you take those income amounts to pay the least amount of tax, and I guess also get the best subsidies for the ACA insurance. All of those things kind of come into play. So kind of why I bring that up is a lot of folks talk about wanting to do Roth conversions to get all of their money out of retirement accounts. And if you have too much in there, strategically converting some of it may help you in the long term. If you have over a couple $1 million in pre-tax, it may make sense early in retirement to convert some of it to Roth, but don't spend it down completely, because that first $30,000 that you take out of a retirement account every year is zero tax. So don't discount that, because that's kind of like the hidden Roth account. So just kind of wanted to chat with that. Learning about this is one of those skills that can help you in your long-term retirement plans, to help you figure out, how do I plan for retirement? How do I think about my tax structure? How do I keep more of my own money? All of those things, every little bit helps, particularly when you've saved large balances. The numbers get bigger, and understanding the tax ramifications of your both pre-tax and Roth accounts and investment, long-term capital gains and qualified gains all help you in terms of planning your retirement out. So just some thoughts today. Don't discount the hidden Roth, which is really your pre-tax accounts, if you just pull a low enough amount out of them every year. They're very tax efficient and a way to get higher gains over the long term. So just some thoughts. Let me know what you think of the strategy, if it helps. If any of you have used the strategy, like, subscribe. Appreciate your time on this channel. We'll see you. Bye.